How does raising interest rates control inflation? Have you ever thought about how raising interest rates can have a big effect on the whole economy? Come along with us on an interesting trip into the world of monetary policy, which is a strong tool used to control inflation. How exactly do central banks use interest rates to keep prices from going up too much? What impact does this have on different parts of the economy, like housing and consumer spending? Prepare to understand the complicated processes that lead to interest rate hikes and learn how important they are for keeping the economy stable. Are you ready to learn more about how inflation and interest rates work together? An indication of easy money is low interest rates. This is what I was told, at least prior to studying monetary policy. This kind of thinking is easily influenced. Interest rates are lowered by the central bank in an effort to increase spending. As a result, borrowing becomes comparatively inexpensive and promotes more investment and consumption. This point of view is flawed because it treats the interest rate as a tool for policy rather than an indicator of the state of the economy. The interest rate can also be seen as a representation of the anticipated return on investment. The cost of renting money is the interest rate. The higher the rate that borrowers are willing to pay to invest the borrowed funds in these profitable activities, the more profit chances there are in the market. Interest rate fluctuations typically mirror shifts in productivity levels without central bank intervention. The short-term swings that are a part of the nature of financial markets cause the confusion. In times of economic expansion, banks typically reduce their reserves and hold down interest rates. But as the boom continues, rates usually go up. All they do is rise more slowly than they would have in the absence of the reduction in reserve levels. Interest rates may rise near the conclusion of the boom to limit lending in a market that is becoming more and more speculative. This surge is just transitory. Interest rates usually decline as one economic boom gives way to a downturn. When looking at actual interest rate statistics, you will see that, as indicated by the gray areas, interest rates typically rise prior to the start of a recession and then decline during or soon after one. This isn't the result of the central bank choosing to let interest rates drop during a recession and hike them during a boom. Central banks typically track changes in market-driven interest rates. The central bank may try and to some extent succeed in changing these rates. The central bank will act sooner rather than later in response to financial market pressures if it does not wish to encourage inflationary problems, as was the case in the 1970s and early 1980s. Interest rates, inflation, and asset valuation. In the market, there is a lot of discussion on the worry of rising rates. This makes sense when looking at a simple interpretation of the present value equation. An asset's estimated future worth, adjusted for the interest rate compounded over the relevant period, is its present value. The following formula describes this, assuming that interest is only compounded at the conclusion of each period. PV equals FE/ON plus or caret. Therefore, in this calculation, the present value would decrease as the interest rate increased. However, investor expectations on shifts in asset values from present to future values shape the interest rate. Put differently, the interest rate will rise in reaction to anticipated productivity gains that will also raise the projected value of productive assets in the future. There isn't a clear, consistent association between changes in nominal interest rates and changes in the S&P 500's value. The value of stocks can occasionally increase in tandem with a significant decline in interest rates. There are instances when a recession causes interest rates to drop, which is linked to a decline in the value of stocks. The data shift outward and away from the origin in the late 1970s and early 1980s, a period of relatively significant inflation, sometimes in double digits, meaning that a given amount of S&P growth is associated with a higher nominal interest rate. Between January 1978 and December 1985, there were 96 monthly data available, and throughout that time, the S&P 500's average monthly value climbed in 71 of those months. The S&P 500's median percent change during this same period was 8.72%. A one-year Treasury had a median rate of 10.18%. In contrast, consider the time frame spanning from January 1970 to December 1977. Just 51 of the 84 monthly observations are in the positive range. Within this range, the median rate for a one-year U.S. Treasury was 6.15%, while the median year-over-year move for the S&P 500 was 6.54%. Indeed, we find a robust positive relationship between the rate of interest paid on U.S. Treasuries and the observed inflation for the preceding year. This is not shocking at all. Irving Fisher discovered that observed rates are a reflection of anticipated inflation through his research on interest rates. Investors take inflation expectations into account and modify their bond purchasing demand accordingly. Any potential trade-off that may exist between interest rates and stock value is susceptible to change whenever there is a significant shift in expectations. This link is liable to alter regardless of it. Additionally, there is a tendency for both values to be positively associated across the economic cycle, with equity values and interest rates, respectively, increasing during a boom and decreasing during a recession. This is the case for both of these variables. Equities and interest rates now. Recent months have seen an increase in the interest rates on long-term U.S. Treasury securities. At the same time that the yield curve's bottom half remains close to zero, the interest rate on 10 and 30-year Treasuries has climbed to levels that are higher than those seen before the COVID-19 event. Many individuals are concerned that rising interest rates would impede the economic recovery that is currently taking place. Simply said, this way of thinking is a wrong one. In light of recent explanations provided by James Gwartney, it seems possible that there is a connection between higher interest rates and increasing money velocity. By advocating for an increase in interest rates that boost the average rate of circulation, it is possible to make the anticipations of higher inflation a reality. In the same way that it did in the late 1970s, this would most likely cause a change and a reduction in the trade-off that exists between interest rates and the prices of stocks. In the event that this is the case, interest rates and inflation will often move in the same direction at the same time or simultaneously. Despite the fact that interest rates have been raised over the course of the past month, Jerome Powell has reassured investors that the economy is a long way from our employment and inflation goals, and it is likely to take some time for substantial further progress to be achieved. Powell has stated that he will not have any plans to raise interest rates in the near future. It seems that the main concept is that inflation will not rise unless there is a decrease in the number of those who are unemployed. At this point, it would appear that those in charge of formulating public policy have forgotten what it was like to experience stagflation in the late 1970s and early 1980s. Some people, on the other hand, are of the opinion that the experience is irrelevant to the current circumstance. When Powell considers the 10-year Treasury note spread, which is currently implied by a projected rate of inflation of 2.36%, he is most likely thinking in his favor throughout this decision-making process. In spite of this, it is not clear if Powell would be willing to support hiking the target for the federal funds rate if inflation increases as Gwartney anticipated it would. In the event that you were to learn that inflation could, in reality, change on a dime, would his viewpoints shift consequently? An increase in inflation expectations of between 5 and 10% could be sufficient, as I have previously explained, to set off a budgetary crisis for the federal government. A further point to consider is that a crisis in the economy could be enough to cause a decrease in confidence in the dollar. The road that lies ahead is littered with numerous opportunities to avoid. However, both fiscal policy and monetary policy continue to follow expansionary paths with a greater degree of daring than we have witnessed during the time when Arthur Burns was serving as chairman. Subscribe now to unlock exclusive insights into topics like interest rates, inflation, and their impact on the economy. Join us as we navigate the complexities of monetary policy and empower you with the knowledge to make informed financial decisions. Don't miss out, subscribe today and stay ahead of the curve.